Welcome to the Deep Dive. I'm John.
And I'm Wendy.
We're staff here at WeWire, and we spend our week digging through data and analysis to put together the weekly StayWired recap.
And today, we're doing a deep dive into something pretty fundamental that's reshaping how we think about inflation.
Absolutely. Get this. More than 80% of world trade travels by sea, and, well, those pandemic-era disruptions, they led to absolutely unprecedented container bottlenecks. When ports clog up and freight rates go through the roof, input costs jump way before central banks can even see it coming, let alone respond.
That really is the heart of it for, decades? Global policy was just laser focused on monetary tools, money supply, interest rates. That was the playbook for inflation. But the source material we've gathered, it paints a really different picture now. It seems global shipping costs, triggered by these physical shocks in the supply chain, they're actually a stronger, maybe faster amplifier of price pressures than currency itself.
Okay, so less abstract theory, more about the actual physical movement of goods.
Exactly. Our mission today is to really unpack the hard data. We want to show you exactly how that simple steel box, the container, is basically dictating economic stability now. And, well, that really demands a fundamental rethink of what economic resilience even means today.
All right, let's start with the sheer scale of this, because the cost surges we saw weren't just like a minor headache for logistics folks. This was a genuine shockwave hitting the global economy.
Oh, absolutely. An unprecedented spike. It just slammed into global pricing models. Take the route from Shanghai to Rotterdam. Super critical trade artery. The price to ship one standard 40-foot container, it jumped from around $2,000 to, get this, over $14,000 in early 2021.
Wow, that's a seven-fold increase.
Yes.
700%. It's hard to wrap your head around any other single cost jumping that much, that fast. You just know CFOs, purchasing managers, they must have seen that number and just panicked, knowing that cost has to go somewhere.
Yeah.
Eventually.
Right. It has to be passed on. And the IMF actually put a number on that relationship. They sort of quantified it. Their analysis found that when container shipping costs double, not the 7 times you just talked about, just the double inflation, tends to rise by roughly 0.7 percentage points.
Okay, 0.7% for doubling. That's significant.
It's huge. And that's the crucial lesson here, really. If you want to understand, let alone control, prices today, you need to be tracking ships, tracking port congestion, almost as closely as you track, say, the Federal Reserve's announcements.
It's fascinating how clearly the economic data actually shows this connection. It wasn't just anecdotal.
No, it's an unusually tight correlation. Our source material really highlights this. There's a composite global shipping cost index, right? And it tracked U.S. import price inflation almost perfectly. They both jumped sharply in 2020 with the first COVID shock. And then they did it again in late 2023 when, geopolitical stuff started flaring up again.
So the mechanism seems pretty clear then. Freight costs go up, import prices follow pretty closely behind.
Yeah, and the Boston Fed study confirmed exactly that. It showed import prices surged basically in lockstep with those freight cost jumps.
Okay, but that brings us to maybe the trickiest part, the timing, the delay.
Ah, yes. The delayed fuse. This is what makes these shocks so insidious for policymakers trying to manage inflation. IMF research confirms it. The full pass-through, from the shipping cost hike hitting the docks to it actually showing up in the prices you pay at the store, that takes time. About a year, roughly, to fully emerge.
A whole year.
Yeah, about a year. And that lag, that's what makes this container data such a powerful forecasting tool, right? Even if a central bank can't immediately hike rates based on today's shipping costs.
But wait, if the inflation impact takes a full year, doesn't that kind of make the current shipping data, well, almost useless for immediate monetary policy? Central banks are meant to be nimble, act quickly.
That's a really critical question, and you're right. They can't adjust rates today to stop inflation that was initially triggered by container costs maybe 12 months ago.
Yeah.
That ship has sailed, so to speak. But the data isn't useless. Not at all. It just changes the planning horizon. You have to look further out. The lag exists for understandable reasons. Think about inventory cycles. Businesses hold stock.
Right, they don't buy new stuff every day.
Exactly. And then there are pre-negotiated contracts between manufacturers and shippers, often fixed for months. Plus, retailers don't just change prices constantly. They tend to wait for new inventory to arrive, or maybe the start of a new fiscal quarter, before they pass those higher costs on to you, the consumer.
So it happens in stages.
Precisely. The IMF breakdown shows it clearly, sort of 3 stages. First, import prices jump right at the dock. That happens within months of the freight hike.
Okay, stage one.
In stage 2, the producers, the manufacturers who rely on those imports, they start paying more. So they raise their prices, the wholesale prices.
Makes sense.
And then finally, stage 3, those higher costs slowly filter through to the retail sector. Consumer prices build gradually, usually peaking about, 1 year after that initial shipping cost shock first hit. And the evidence backs this up strongly. They looked at specific trade routes. Routes that saw bigger cost spikes definitely saw faster import price growth for the very same goods compared to cheaper routes.
So we're talking about a physical thing, the cost of moving a box, creating this predictable but delayed financial outcome down the line.
Exactly. A physical bottleneck translates directly into future inflation, just with a lag.
And this vulnerability isn't spread evenly across the globe, is it? Some countries feel it much more sharply.
No, definitely not. It hits hardest where import reliance is highest. The IMF data consistently shows this. Shipping cost surges drive up headline inflation particularly hard in economies that import a large share of what they consume.
Which points directly to, say, landlocked developing countries or small island nations, places where the cost of freight is already a massive chunk of the final price of goods.
Precisely. They have less resilience to these shocks.
And we've seen recently how specific choke points geographically can become these critical, almost recurring nodes of inflation because of geopolitics or climate change.
Yeah, 2 really powerful examples just recently. In late 2023, early 2024, you had the Houthi rebel attacks in the Red Sea. That forced pretty much all the major shipping lines to just stop using the Suez Canal.
Right, a huge disruption.
Massive. The detour around Africa, around the Cape of Good Hope, it adds weeks to transit times. And shipping costs on those Asia-Europe routes, they shot up over 150%, almost overnight.
And the second big one wasn't conflict, it was climate.
Exactly. The Panama Canal drought. Spring 2023, it was severe. Low water levels meant they had to drastically cut the number of ships and the size of ships that could pass through each day.
Forcing ships, especially coming from Asia to the U.S. East Coast, onto much longer, more expensive routes.
Same economic outcome, different cause, and this kind of disruption feeds directly into core prices over time. Fitch Ratings actually modeled this. They looked at a 150% shipping cost spike, kind of like the Red Sea situation, and their models suggested it could eventually add about 0.4 to 0.5 percentage points to core consumer inflation.
0.4 to 0.5%, just from that one disruption filtering through.
Yes, it really confirms that things like climate change and regional conflicts, they aren't just sort of external risks anymore. They are now direct, measurable drivers of the prices you pay domestically.
Okay, so where do things stand now? What's the current state of the market, and what does this all mean for policy going forward? Because rates have come down from those crazy highs, right?
They have, thankfully. The market has definitely cooled off. Drewry's Global Container Index, a key benchmark, was sitting somewhere near $10,650 recently. That's a huge drop from the $14,000 peak.
Big relief, yeah.
Yeah, but, and this is the crucial point, the underlying system, it's still really fragile. And that fragility is shaped largely by factors that central banks just don't control, non-monetary factors.
Like the decisions made by the big shipping companies themselves.
Exactly. You have these huge liner alliances, just a few massive groups that dominate global shipping. They have enormous influence over pricing and capacity. Remember the Red Sea crisis? These alliances basically acted together, almost instantly halting Suez transits. That immediately pushed up costs on the longer Cape routes because capacity tightened everywhere.
And then there's the ongoing climate pressure.
Right. Climate change isn't going away. Worsening El Niño patterns, for instance, are making Panama drier. That directly hits canal throughput. It's a recurring physical constraint.
So this really brings us back to the main argument, doesn't it?
Yeah.
That control over physical shipping routes and logistics is now, fundamentally, almost as important as controlling the money supply for ensuring economic stability and managing inflation risk.
I think that's the unavoidable conclusion from the data. And it really requires central banks and governments, too, to fundamentally change their approach. Their traditional playbook isn't enough.
What does that mean in practice? Especially for, say, emerging markets?
Well, for emerging markets particularly, genuine resilience means serious investment. Investing heavily in their own regional port capacity, pushing for more automation in ports to speed things up, maybe building more redundant local supply chains so they're less reliant on these super long, volatile, deep-sea routes.
Things central banks don't typically get involved in.
Exactly. Central banks can raise interest rates to cool demand, sure, but they can't, physically move a stuck container ship or dredge a canal or speed up unloading at a congested port.
So what kind of non-monetary tools should policymakers be developing then, if the old tools aren't sufficient?
We need, I think, more integrated national logistics strategies. Maybe things like strategic reserves for port capacity, mandated investments in port automation, proactive government planning to identify alternative transport modes like rail that could substitute if a major sea route suddenly closes.
And forecasting needs to change too.
Absolutely critical. Inflation forecasting has to evolve. It can't just be about labor markets and output gaps anymore. Central banks need real-time, forward-looking logistics data. Things like live vessel traffic feeds, container dwell times at ports, congestion indexes, because those are the indicators that are increasingly telling you where core inflation is headed next year.
That structural reality, that physical dimension, it really casts the weekly market movements in a different light. Let's look at some of the StayWired weekly recap highlights through this lens.
Okay, good idea. If you look at the commodities corner first, oil prices actually struggled, heading for a weekly loss. Why? Partly because of a surprise build in U.S. crude inventory.
More supply than expected.
Right. Now, oil prices reflect lots of things, demand included, but that inventory build also hints at shipping efficiency. Supply is actually getting through to the market, which, at least temporarily, puts downward pressure on prices. The logistics worked in that case.
Okay, contrast that with gold.
Gold had a powerful rebound, hitting record highs, past $4,300, peaking near $4,378. Driven by classic safe haven demand, right? Geopolitical worries, bets on Fed rate cuts.
So the same global instability like conflicts potentially affecting shipping lanes that can drive freight costs up also pushes investors towards safe assets like gold.
Exactly. Two different markets reacting to the same underlying instability, often driven by these physical world events.
What about the market movers?
Well, we noted the IMF warning about domestic borrowing risks in sub-Saharan Africa. This is often where that freight cost shock lands hardest. Import-reliant nations feel the pinch, inflation rises, and sometimes they have to borrow more just to maintain consumption levels. It ties back directly.
And the Trump comment about a potential cooking oil embargo on China over soybeans? That sounds like exactly the kind of geopolitical trade friction that could disrupt specific shipping flows if it ever happened.
It certainly could. It highlights how trade policy and potential disruptions are always lurking. We also saw Israel's inflation dip slightly to 2.5% in September, but that region remains a focal point for geopolitical risk that affects shipping, especially via Suez.
Okay, and then FX Africa Spotlight. This was interesting. Ghana's cedi surged.
Yeah, quite sharply. The cedi appreciated 10.84% against the dollar just week to date. GHS 11.0 per USD, its strongest week in months.
Why the surge?
Seems driven by offshore inflows, maybe some improved fiscal sentiment. But for an import-heavy economy like Ghana, that currency appreciation is a big deal. It directly helps dampen the landed cost of imported goods, providing some temporary relief from those global price pressures.
But still down significantly year to date.
Oh yeah, still down around 40% year to date, so it's relief, but from a very tough position.
And Nigeria, by contrast.
The Naira gained only slightly, just 0.20% week to date, still down over 4% year to date. And the big story there remains persistent, high domestic inflation.
So even if the currency gets a tiny bit stronger.
Right. It showcases that fundamental challenge. Any small relief from currency strength often gets swamped by the underlying structural costs of actually getting goods into the country. And a huge part of that cost is dictated by global container prices and those logistics inefficiencies we've been talking about.
So wrapping up our deep dive today, the central idea seems pretty clear and frankly quite powerful. The container really is mightier than the currency in many ways. Physical bottlenecks, these maritime choke points, even climate change impacts, they're dictating price pressures directly. They force input costs up long before traditional monetary policy can even register the problem, let alone fix it.
It's a fundamental shift in understanding inflation drivers. And it leaves us with a really significant challenge, maybe the defining economic challenge for the next decade. If geopolitical conflicts happening thousands of miles away or weather patterns like El Niño drying up canals, if these are becoming primary, immediate drivers of core inflation in your country, then what non-financial physical tools do central banks and governments actually need to develop? How do you build resilience and secure economic stability in an age that seems increasingly defined by these physical disruptions? That's the big question. And the answer almost certainly lies far outside the traditional toolbox of just adjusting interest rates.
StayWired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the StayWired Weekly Recap.